Hello there, everyone, and welcome to our latest episode of the Market Misbehavior podcast. My name's Dave Keller. I'm the president and chief strategist of Sierra Alpha Research and the host of Market Misbehavior. I'm so glad that you joined me on today's show. Our goal with the Market Misbehavior podcast is to sit down with top market practitioners, analysts, educators, authors, money managers, portfolio managers, traders, brokers, anyone that has a great experience in the financial markets, willing to share some lessons learned and words of wisdom with us, and also help us gain perspective on the markets during uncertain times. Today, a really interesting guest, Rob Thummel. Rob's a managing director and senior portfolio manager at Tortoise Capital, based in Kansas City, Missouri. Rob has been in the energy markets for his entire career. He focuses on energy companies, and I found being able to ask someone like Rob some very 101 straightforward questions about why and how we think about the energy sector, its relationship to crude oil prices, how that thinking should change as the dynamics and the fundamentals of the energy sector have evolved. I thought that was just that general theme was fantastic, and I really appreciate Rob's willingness to sort of walk me through some of the ways, the many ways that the energy sector has evolved. We talked about old energy, like oil companies, versus new energy, green energy, how they think about the opportunities in newer energy sources and new energy technology versus some of the great benefits of things like natural gas. We talked about how energy is really the lifeblood of the economy and the energy requirements, not just of normal consumer and behavior of people in the United States, but also AI and the incredibly growing energy needs of artificial intelligence and how the energy infrastructure in the U.S. stands to really gain from that. We talked about the top-heavy nature of the XLE, right, which is the energy sector spider ETF, where Exxon and Chevron make up about 40% of that ETF, and talked about some of the opportunities a little lower down in the cap tiers within the energy sector. Rob did a great job just describing the different parts of the energy sector. It's not just big integrated companies like Exxon and Chevron. There's a bunch of other things as well. We talked about pipelines. We talked about natural gas in particular. And I think the way he described the opportunities in those areas was very much appreciated. We talked about geopolitical risk, why the markets have not reacted as negatively as you might expect from events in the Middle East, from events with Russia and Ukraine, how U.S. energy independence has really changed the game in so many ways, shale technology and what that has done to allow the U.S. to be more self-sufficient, how we're an exporter of natural gas and what that means in terms of the dynamics going forward. This was a great conversation. If you've ever looked at the energy sector, ever thought about investing in that space, I hope my conversation with Rob Thummel will maybe nudge your thinking in a number of different ways, where some of the opportunities may lie going forward. I have, I think, again, sort of a old way of thinking. I tend to think of the energy sector as tied to crude oil prices, and Rob quickly dispelled that myth, although we did talk about some of the companies and certainly the economy and economic realities of being tied to crude oil prices. But there are a lot of opportunities, whether or not crude oil prices go up or down, in terms of infrastructure, natural gas, and other areas of the energy sector. So please enjoy this fun conversation with Rob Thummel of Tortoise Capital. So super excited to be sitting down today with Rob Thummel. Rob is the managing director and senior portfolio manager at Tortoise Capital in Kansas City. And Rob, listen, I've followed your work and you've done, I think, such a fantastic job of helping people understand energy, the energy market. So I'm super excited our audience gets a chance to learn from you today. So thanks for coming on the show.
Well, hey, thanks for having me, David. Happy to share some more insights with your viewers and your listeners.
So for sure. Now you and I were talking before we got started. I feel like a lot of people, and probably I'm guilty of this as anyone, right? When you think of the energy sector, it sort of generates these particular images or these particular ideas about what a bet in the energy sector is actually doing, and it's old school, fuel out of the ground, fueling automobiles, and that's kind of it. What can you tell us? I mean, just start us off with an appetizer for this meal we're going to have together. Just help us understand, how should we be thinking of the energy sector? What would you hope people understand when they're making a bet in energy today?
Yeah, no, you're right, David. So most people think energy, the immediate thing that comes to your mind is gasoline, driving your car, maybe heating your home or something along those lines. And
Yeah.
that's right. Energy is an important part of that. But energy is so much more than that, right? So basically, energy is kind of like the lifeblood of the economy, the way I think about it. So energy is
Mhm.
basically in everything. It's in over 9,000 consumer products. Obviously, it's really important in the transportation industry, in the heating industry. But there's consumer products, it's spread across almost every consumer product. So if you just look around you, basically there is some sort of an energy, in a form of energy, I guess, in every single consumer product that you're using, whether it's your chair, your computer, whatever that may be. So it's really, really important. But the sector also, is we think is really, uh, developing and growing, and really being redefined. And we can talk a little bit more about that, why we feel that way. But it's a really important sector. It's a really essential sector, really for investors, but really just for economies in general.
Yeah. No, that's really well said. And I really, again, I hope through the course of our conversation, Rob, we can maybe help inform and educate people to think a little bit differently. So this next question may be below your pay grade, Rob, and I appreciate your patience in indulging me on this one. But for a lot of people, they think of the energy sector as Exxon and Chevron, or maybe ConocoPhillips and some other random oil company that they've come up with. Help us understand, when you think of like the XLE or you think of the energy sector, what are those other components besides just like big integrated oil companies we probably know? What are the other kind of pieces of the energy sector that roll up into that sector that a lot of us sort of think of as one homogenous beast, I guess?
Yeah, absolutely. And that's a very good question as well. So Exxon and Chevron, great companies. Conoco, great companies. But you're right. That's a limited in scope in terms of they are the largest energy companies. But when
Mm.
you think about the vast nature of the energy sector, and at Tortoise, this is all we do is focus on the energy sector. We look at it really as through a much wider lens. So there are oil and gas producers. That's kind of like Exxon and Chevron and ConocoPhillips, who you mentioned, and they're obviously very important in producing the oil and the gas. And there's been a phenomenal story that's happened there with the development of U.S. shale technology. Then there are the energy infrastructure operators. Those are the pipeline network. The U.S., not a lot of
Mm.
people know this, but the U.S. operates the largest pipeline energy infrastructure network in the entire world. And oh, by the way, all of those pipelines you can invest through publicly traded entities. That's kind of a rarity that you can find. But if you think about the pipeline network, that's really important. And then there's the downstream, where the energy is being produced, obviously by the producers, being transported by the energy infrastructure operators, and then it's being utilized or used by consumers. And those consumers could be you and I, in our homes. Or it could be, refiners, right? The refining industry is a big industry. The U.S. is one of the largest refiners in the world, and so, the refiners actually, take the oil, turn it into gasoline, diesel, jet fuel, so on and so forth. But then also the utilities, the electric generation facilities. This is really important as well, and
Mm.
this is going to be really important going forward. But natural gas is one of the largest sources of energy supply to generate electricity in the U.S., and we have some of the lowest cost electricity in the U.S. Carbon emissions have declined as well in the U.S. because of increased use of natural gas. So you're right. The energy sector is vast. It's wide. There's a lot of companies, and there's a lot of opportunities as well for investors.
I really appreciate you going through that. I think that alone is worth the price of admission for this discussion. I appreciate that, Rob. Talk to me a little bit. I mean, with the XLE in particular, I want to go through a lot of these points in a little more detail. With the XLE in particular, you have, which is how I think a lot of people sort of very passively gain exposure to energy, right? You buy the XLE and kind of that's the bet you might be making. You're making a very concentrated bet in Exxon, Chevron. You probably add ConocoPhillips. That's probably about 45%, maybe 50% of the XLE, just with those three names. Can you talk a little bit about, I guess, how do you think about that over concentration, the top heaviness? Why would maybe more of an active way of approaching the energy sector allow us to avoid that? Like, how do you think about the concentration of some of those bigger names?
Yeah, yeah, and like I said, those are great companies. But what you have to remember when you take that concentration risk, you are just really taking, risk, not only just concentration, but just in their business models. And the business models of those companies that you mentioned, of the producers just in general, which includes all of the names you mentioned, Exxon, Chevron, once again, great companies, but they have much more volatile cash flows. And the reason for that
Mm.
is because their cash flows are generally tied to the oil and natural gas price in general. And as we all know, commodity prices go up and down, and so cash flows go up and down accordingly. What we like from an active perspective is, and there are times when you want to have a little more exposure to those companies. What we like in particular at Tortoise is more of the steady state energy infrastructure focused companies. And the reason why is because you don't have necessarily that exposure, and you don't have the necessary exposure to the volatility of the cash flows being tied to the commodity price. The cash flows of infrastructure are just tied to the economy. And does GDP go up? Because energy and the energy demand and GDP go up kind of hand in hand. So we like the energy infrastructure companies, less commodity, actually very limited to low commodity price exposure, more tied to just volume growth. And we've seen significant volume growth in the U.S. And we look at it from a macro perspective. You see the U.S. is the largest oil and gas producer in the world, the largest energy exporter in the world. And then we've got this AI opportunity for the energy sector. You put all those together, energy infrastructure is just a great place to be. Plus, you get some really good dividend yields on these stocks, plus a little dividend growth. And we think that those are just compelling valuation attributes for the sector in general.
I have to admit, I mean, as you're talking, I'm embarrassed to admit, Rob, I feel like I'm guilty of that very simplistic way of thinking about the energy sector as a bet on crude oil, right? So if you think crude oil prices are going up, that's good for oil companies. That means you want exposure there. But some of the themes that you highlighted, right? I'm thinking of things like Cheniere, right? LNG, Williams. And again, from a technical perspective, these are some of the better charts you could find right now. And I think in some of these infrastructure names that you're talking about, can you talk a little bit more about how and why these particular companies and these types of companies seem to be performing better than others and better than you'd expect, given the fact that crude oil prices have remained relatively low, right, in 2025?
Yeah, David, I really appreciate you saying that, because you're right, and this is part of our job, is to educate investors. And like I said, that's all we do at Tortoise, is focus on the energy
hosts,
sector.
apparently.
But that, to that point, a lot of people just think about oil in the energy sector. But at Tortoise, we really think that the energy sector is being redefined. And what's going to really shape the energy sector over the next several decades is natural gas. Oil's still going to be around. Oil is still an important commodity. It's actually it's the largest fuel supply source in the world, and it probably will stay that way for quite a while. However, the growth in the future in the energy sector, and why we think it's being redefined, is in natural gas. So what you mentioned, that's why you're seeing those stocks and those stock charts. And I'm not a technician like you are, but that's why the stock charts are doing well, because the fundamentals of the companies are improving. Natural gas demand is rising. Liquefied natural gas exports out of the U.S. are increasing. So company like Cheniere, the largest LNG exporter in the U.S., one of the largest LNG exporters in the world. They export liquefied natural gas to other countries around the world. Its cash flows are going up. That's why you're seeing some nice improvement in the stock price. Williams, owns the largest natural gas, one of the largest natural gas pipeline networks in the U.S. Just think about the economic moat of a company like a Williams or a Cheniere, these infrastructure companies. You cannot replicate these assets. And so they have these strong economic moats. They have rising cash flows. And then they pay, in the case of Williams, a really high dividend yield. It's probably 4 or 5% right now. It's going to grow another, probably 3 to 5% this year. And oh, by the way, that's assuming that they don't have any more growth. And this opportunity with AI and the need for electricity demand. So for the first time, David, in 20 years, we're going to have electricity demand growth in the U.S. The last 20 years, and that's not being talked about enough. And you're going to hear more about it. For the last 20 years, electricity demand growth in the U.S. has basically been flat at 4,000 terawatt hours. Between now and 2030, we're going to have significant growth in electricity demand. The electricity generation network, the electric utility network, is going to need more natural gas from Williams, basically, to generate electricity, because over 40%, the largest energy supply source to generate electricity, comes from natural gas. That's over 40% of the energy supply source to generate electricity today.
Right. So I hadn't really appreciated until you and I spoke, Rob, today about that connection between natural gas, between the energy infrastructure and AI. Right. I mean, we've thought about AI and implications for technology, for consumer names, for industrial names, but this is an angle that makes a ton of sense to me. Talk to me a little bit. I mean, so some of these names, like a Williams, right? One of the better charts I could find for you, and the fact that it's not going down at a time when so many things seem to be here, in recent weeks and recent months. Can you talk a little bit? I mean, if the upside potential, given the energy needs of AI, is so real, how much of that optimism is priced into these names today? How much of those provide an opportunity for future growth in earnings, future growth in valuations? And how do you sort of differentiate between the two, right? How do you sort of understand how much optimism is priced in already?
Yeah, well, a couple ways. So first of all, we have a saying at Tortoise, David. We say there's no AI without EI. So there's no AI without energy infrastructure.
I
So
love
it's
that. That's good.
really
That's good.
important, right? It's really
Yeah.
important. Obviously, you need the technology infrastructure, but you need the energy infrastructure to generate the electricity to keep these data centers operating 24 hours a day, 7 days a week, 365 days a year. So that's really important. But how much of that is really factored in today? I would say not very much, and
Yeah.
for this reason. So if you just look at a Williams, once again, and you look at its multiple that it trades at, and we look at the multiple being the enterprise value to EBITDA as the
Okay.
primary valuation multiple, and we look at what Williams is trading at today versus where it's traded at historically. It's actually trading at a discount to where it's traded at historically. So. Normally, I would tell you, well, yeah, if it was trading at or above its historical multiple, obviously, I'd say, well, yeah, there's probably a little valuation in there, growth expectation from artificial intelligence and increased natural gas demand. But what I'm telling you is Williams is actually still trading at a discount to where it's traded historically. And obviously, historically, there was no discussion about anything about AI and what that meant. So that said, there's the opportunity now going forward, right, for Williams to grow itself through a lot of other means. Like if we're going to, so for instance, LNG exports, Williams will have a role there. If we're going to reshore and bring back manufacturing to the U.S., that's going to require more natural gas for the industrial facilities. Williams will have a role there. But
Mm.
then on the AI side, if we're going to build all these data centers and power them with reliable, steady, consistent power, Williams will have a role there. And in fact, they just announced last quarter, maybe last month, a $1.6 billion project that's going to be in the future where they're actually going to provide the natural gas and the natural gas generation to a data center, and that's going to be built over the next couple of years. But they're going to actually get directly involved in that type of a business, and so that's just the start. We're in the early innings, right, of that happening. So maybe the first or second, maybe not even the first or second inning, maybe the first inning, we still may be on deck. So there's just a huge opportunity there where this sector then can continue to rise and grow. And we think that's the opportunity for investors.
Yeah, no, it's really compelling. And again, I think the opportunity, the long game with some of those with some of the AI plays makes a ton of sense. And I appreciate you, Rob, talking through that. So one thing that has not come up in our conversation yet, and I'm thankful for that, but now I'm going to go there, are tariffs and all that we've learned with that. I mean, my gut would be, particularly companies, with energy names, I would not assume are big, going to be affected by tariffs a ton. But talk to me about some of the materials that are needed for the infrastructure and everything that we need. Are tariffs an issue, and how is that affecting your thinking of how to value companies today?
Yeah, so tariffs from a big picture perspective, operationally for the individual companies, we don't see tariffs having an impact much on the companies themselves. I know, you'd say, well, they're building pipelines. Do they are there the steel tariffs? Are there steel tariffs? Will there be? The short answer is the infrastructure network is pretty well built out. The so
Okay.
we're not there's not a tremendous amount of money being spent to build out the network. So then the question then is, well, where could the tariffs impact the companies? And it's more so just on the macro and what happens with the economy. So if you go back and look, clearly
Mm.
energy demand and GDP growth basically go hand in hand. So GDP growth goes up, energy demand goes up. for the energy infrastructure companies, that their cash flows go up as well when the volumes go up. So obviously tariffs could cause a slowdown in economic growth, both domestically and globally. We'll see how that plays out, and that would have a short-term impact, obviously, on the companies. But I would make one really important point. If you go back and look in history, 40 out of the last 42 years, global energy demand has increased. It's only gone down 2 years, and that was 2008 financial crisis, and it was obviously the COVID year. So this year we're going to set a brand new record globally. Obviously we're going to set a record for energy demand in 2025. More than likely, we're going to set a new record in 2026 because energy demand just keeps rising. And by the way, the U.S. is playing a more important role and more critical role in supplying the energy, obviously domestically, but globally as well.
So that's awesome, Rob. And let's talk a little bit more about that because, and again, this is probably, I feel like we're unpacking all of the antiquated ways I've probably thought of the energy space and probably some of the listeners as well. You think about the geopolitical risk, you think about a crisis, continuing in the Middle East, a crisis with Russia and Ukraine. These are oil producing regions. So generally, I would think, okay, this probably is affecting the price of crude oil. This is probably affecting energy stocks. Can you talk a little bit about the impact or maybe lack of impact in some of those conflicts? Could that change? And what would you see that would tell you, all right, this is something that means we need to reevaluate conditions on U.S. energy companies? How do you think of the geopolitical risk here?
Yeah, well, and you're right the way you're thinking about it. The biggest thing that I think a lot of people underappreciate is the impact that the U.S. shale industry has had on the energy industry, but also just on the U.S. And here's why. Because the U.S. shale industry basically created, a brand new source of energy supply, and it's a massive energy source of supply. And the U.S. has grown into become the largest energy producer in the world, the largest energy exporter in the world. That shale technology is what I call it shale technology. That's one of the most impactful technologies, probably the most impactful technology in my 30-year career looking at energy. But what I think is underappreciated is how much of an impact shale technology has had just on the U.S. economy and on the global economy, because it's been able to keep prices lower for the exact reason that you mentioned, because we don't have to worry as much, still have to pay attention to geopolitical risks, no doubt, but it has just a lesser of an impact. Because if we have some crisis and oil supply drops temporarily in the Middle East or Russia or wherever that may be. Now, we can't just flip the switch overnight and have the U.S. shale producers, fill that gap. But over time, the U.S. shale producers could help fill that supply gap that temporarily was there. But more importantly, just think about what happened in Russia, Ukraine. That's the classic example. And this is why natural gas, we think, has such an important role. We all know, effectively, natural gas supply out of Russia to Europe cut off immediately at the worst time of year, almost at the start of winter. You know what? That had an impact on Europeans, and I'm sure there's several of the listeners that had a bigger impact on than maybe what I'm giving it credence for. But that said, U.S. was basically able to step in, produce and more natural gas, export it to Europe, and make the impact of that really crisis become much less. And so that's why the U.S. can play such an important role going forward. And that's why these energy companies, I think, are underappreciated in the sector. But we don't have to worry as much in the U.S. about these geopolitical risks because the U.S. is energy independent. The U.S. has energy security. And that's really something that's really important and this energy sector really offers.
No, really well said. And I think that change in sort of, I guess, U.S. dependence on foreign oil versus energy independence, I feel like a lot of us probably struggling to get our head around the fact that the world has changed quite a bit. Certainly with some of the new shale technology, I think is very well said. Talk to me a little bit about green energy, right? How do you think about the potential upside for natural gas producers, for energy infrastructure with all the needs of AI versus alternate forms of energy? We're coming out of a presidential administration, which was very, gearing the U.S. economy towards green energy. Arguably, we're seeing a very different administration here now, but over the long term, how do you think about wind, solar, nuclear energy relative to the opportunities with companies more traditionally listed in the energy sector?
Yeah, no, that's a great question, David. So the way we look at it is so at Tortoise, we do focus just on the energy sector. So we look at
Yeah.
all energy technologies. We've been studying all energy technologies, look at them all. U.S. shale was a technology at one point in time we looked at. Obviously, it was been very successful. LNG was a technology that
Yeah.
we've looked at. And so so as we look across all energy technologies, we say, okay, we know big picture that we're going to need lots of forms of energy going forward. We just need more energy to boost economies globally. And there's still a lot of people in the world that don't even have access to very simple qualities of life. So we need to basically take energy, help reduce energy poverty as well. And a lot of these companies that we're investing in are attempting to do that as well. But specific to your question, then is how do these energy technology emerging energy technologies play? Well, solar and wind. Let's talk about that. We do invest a little bit in a few solar and wind companies, but
Mhm.
that technology is still developing. It's not fully commercialized in that it's still not as economic as producing electricity with natural gas. And
Yeah.
so if you think about what natural gas has done, natural gas, a lot of people don't know this. This is another important point, I think, that you may or may not know, but actually carbon emissions in the US over the last 20 years have declined, not increased, they've
Nice.
declined. And that partially is and almost primarily due to the fact that the US has produced more electricity using natural gas and less coal. That's the reason for that. Now, going forward, we'll still need probably solar and wind, but we're watching that and we'll see how that develops. The same thing with nuclear, right? So nuclear energy is kind of making a resurgence. It's a very clean form of energy. It's we're seeing new nuclear facilities I say new nuclear facilities, old facilities that are going to be restarted, basically, right? Potentially, that's going to take a little while, but there's potential for that. We're seeing new technologies in the nuclear sector called small modular nuclear reactors. We can get into the details. I'll just say none of those nuclear reactors actually are operating today, and they still need a lot of approvals. But we're watching them very closely, and all of them have potential. So when we look at it, we look at all the technologies, David. But when it comes back to where we see the opportunity right now, and really now and in the near term, and I'll say the next 5 to 10 years, we still see natural gas as being the best opportunity for investors because of the growth potential and really the cost advantage that natural gas has that will lead to that growth potential. And oh, by the way, like I said, it actually reduces carbon emissions as well.
No, this is well said, Rob, and I appreciate it so much. Just to finish off here, I mean, so we've talked about a number of things that certainly seem encouraging: natural gas, infrastructure, the AI opportunities. Just finish this off. Any particular names or places where you see opportunities now that people are probably underappreciating? Where are you focusing your positioning now at Tortoise?
Yeah, so I think when you look at you look at our funds, we've got our ETF, the Tortoise Essential Assets Fund, TPZs, that is the active ETF. We're focused on two themes there. We're focused on electrification, really, and a little bit of energy exports as well. And so electrification are the pipelines, the companies like Williams, TC Pipelines, Kinder Morgan, all of which are providing that essential infrastructure network to really increase the volume of natural gas to these electric power plants to really develop this AI opportunity that we have in the U.S. And we think it's going to be really big as well. And then on the energy export side, it is the exporting of natural gas and
Mm,
LNG, and we benefit from that from Cheniere Energy, as we talked about earlier. So yeah, we see
sure.
those as significant opportunities going forward for the energy sector. And so we think that those companies offer really good dividend yields, dividend growth, and still trade at discounts to where they've traded at historically. And so that's what we get excited about when we wake up every day thinking about energy at Tortoise.
Rob, selfishly, I will tell you this is a really fun conversation. It really helped me stretch my thinking a bit about the energy sector, and I'm sure people watching and listening would say the same. So thanks so much for coming on the show. For those that want to learn more about Tortoise Capital, the ETF that you mentioned, the Tortoise Power and Energy Infrastructure ETF, and other funds, where can we point them to learn more about you?
Yeah, well, we at tortoisecapital.com, we have our website, and people can contact us through the website. We have a phone number there as well. But we try to put out a lot of podcasts. We try to put a lot of content to try to help educate everybody, and we're always welcome for questions if anybody has questions on the sector. Like I said, this is all we do at Tortoise. We love it. We love talking about it. So thank you for having me.
No, it's a pleasure, Rob. Thanks again for coming on the show. I hope we can continue the conversation down the road, all right?
Sounds great, David.
It was a great conversation. Thanks again to Rob Thummel of Tortoise Capital joining us on the podcast today. Really appreciated his perspective. I mean, it's great to be able to ask someone like him some questions that have been bugging me for a while about the energy sector, thinking about crude oil prices. And again, I often talk about and think about how the energy sector is basically just a play on crude oil prices, and not the case, right? I mean, for certain companies, it certainly has a real impact. But we talked a lot about other areas of the energy sector, and really appreciate Rob sharing some of his experience and insights on how we could think of things a little differently. Had not really appreciated the AI upside. We've certainly seen the upside for utility companies performing more like a growth sector because of the electricity requirements of AI and cryptocurrency mining, etc. But really thinking about energy infrastructure in the U.S., things like pipelines, things like natural gas, how they are tied also in many ways to the upside potential with artificial intelligence, I thought was a really interesting takeaway. I asked him about some of the stocks that I have the most compelling technical setups, in my opinion, right? I mean, the stocks with the best charts in the energy sector haven't been sort of the big integrated companies or oil producers. It's been other areas of the market. And I think his discussion about opportunities and expectations in those other areas of the energy sector really mapped very well from what I'm seeing from a technical perspective. Hope you enjoyed that one. And again, I'd encourage you to check out Tortoise Capital and some of the opportunities they provide to help you understand and gain exposure to the energy sector. So thanks again to Rob Thummel for joining me on the podcast today. If you want to learn more about some of the charts that I was showing as I was talking with Rob, some of the ways we can analyze opportunities in areas like natural gas and pipelines, as well as traditional energy companies like oil producers, explorers, and producers, our Market Misbehavior Premium memberships may be a great way to improve your own market awareness of the energy sector and the other 10 S&P sectors as well. 3 great benefits of the Market Misbehavior Premium membership. First off, immediate access to all of our virtual courses. We'll teach you all about technical analysis, behavioral finance, what's happening between your ears, why we're wired to make poor decisions, how we can use technical analysis to minimize those behavioral biases and make better decisions based on better routines. You also get access to our members-only reports like our weekly flight plan, where we look back at the week that just occurred. We look forward at the week to come, focus on key levels, patterns, and signals that we're watching for. We also apply our proprietary market trend model to a series of ETFs and asset classes in our monthly chart review, which we share with all our premium members as well. Finally, you'll have full access to our members-only community where you can ask questions, you can learn from the questions others are asking, and I'm in there every morning answering questions from some of our premium members about particular charts, about technical indicators, about different ways of analyzing the market, routines, decision-making. All of the above is fair game, and it's a lot of fun to navigate these markets during a challenging period. It's so much better doing it with a group of like-minded investors. So if you're interested, go to marketmisbehavior.com/premium for all the details. And also make sure you use the code PODCAST when you check out for 30% off your first 12 months on any plan. That'll do it for today. Thanks so much for joining me here on the Market Misbehavior podcast. I'm Dave Keller, and remember, it's always a good time to own good charts.